Ethical decision-making, corporate governance, accounting, and finance. We're finally reaching the end of the course where we bundle all of the concepts we've covered up to this point under the leadership and administration of those people we expect to exemplify and uphold ethical actions and policies within the company. Early on, we took a good look at the Congressional Sarbanes-Oxley Act that was born out of the Enron accounting fraud scandal. The result was tough new rules that remain a source of controversy. One of the arguments is the new rules force companies to do too much expensive work that doesn't justify the effort. The other, though, is that trust in corporations is now much higher, and that's of tremendous value. We'll continue with a look at the roles of our gatekeeper professions that we rely upon as those first lines of defense in upholding corporate ethical standards: our accountants, lawyers, auditors, and analysts. One effort to help provide guidelines to improve financial reporting is a voluntary collaboration called the Committee of Sponsoring Organizations, or COSO. We'll deal with the internal efforts to achieve an organization's objectives to set the tone and influence consciousness of its people. That's called the control environment. Boards of directors also figure prominently in the ethical course of an organization. And we'll take a look at the legal obligations of board members and their own ethical obligations. Other major ethical conflicting issues include interest that individuals have in financial markets, excessive executive compensation, and insider trading. Now, in many respects, business is often referred to as a game. Top executives are known for expressing their goals as game plans, and they sound an awful lot like football coaches in motivating their players, or make that their employees. But football, basketball, baseball, and all the other games do have rules, and so does business. Remember our work on Milton Friedman, the free market defender? Well, even he maintained that business needs rules and standards and must uphold the law and remain free from fraud and deception. This brings up the need for internal controls, and the lead in this is the corporate or company accountant, considered a gatekeeper or a watchdog profession. Think of the accountant as the company referee, and other referees on the team are attorneys, auditors, and financial analysts. And it's important that these gatekeepers avoid conflicts of interest, that is, benefiting personally from advice given to corporate leaders, such as accepting kickbacks or using confidential information for their own personal advantage. Then there's also what's called a fiduciary duty to keep the interests of their clients or employers ahead of their own. For instance, you wouldn't want your real estate agent to tell a potential buyer of your house or commercial building how low a price you'd really be willing to accept. Well, in all of this, let's go back to the Enron case. Enron was the Houston energy-based company that grew into a huge corporate giant, was even considered for years to be a leading innovator. But what was going on behind the scenes was massive accounting fraud to manipulate the markets. One of the greatest cases in all world history. When Enron filed for bankruptcy in 2001, employees and stockholders lost billions of dollars. Many lost their life savings and their retirement programs. Thousands of jobs were lost, and the much-admired Arthur Andersen Big Five accounting firm was brought down. Then there were all the trials, convictions, and even a suicide. Well, the argument goes that extraordinary executive compensation, and with so many others involved in having the potential to get rich, that it all led to the environment where our traditional watchdogs had little ability to stop what happened. The oversight of accountants, lawyers, and even the corporate board was lacking. So in reacting to the problem, the U.S. Congress passed Sarbanes-Oxley, known as the Public Accounting Reform and Investor Protection Act of 2002. Sarbanes-Oxley, or SOX as it's called, basically requires reporting trades by insiders, public reporting of chief executive officer pay and compensation, auditor independence, a requirement that companies must have internal audit functions and certification by outside auditors, and that certification of the financial reports by the chief executive and chief financial officers be made. A number of states and even nonprofit organizations have since adopted the SOX standards. Now, the criticism of SOX Section 404 compliance is that it's added billions of dollars in unproductive work and cost to firms. But on the other hand, the compliance provision has given stakeholders and investors more confidence in their financial reports. Sarbanes-Oxley is what is called an external control mechanism, but there are also internal mechanisms of control. The Committee of Sponsoring Organizations, or COSO, advocates a framework for internal controls. Now, COSO is voluntary, and it advances internal governance standards called the Internal Control Integrated Framework. The basis is the control environment. This refers to issues such as integrity, ethical values, competence, philosophy, and operating style, which then leads to provisions of a division of authority, reporting structures, roles and responsibilities, and codes of conduct. But to make all of this work is to make ethical controls part of the corporate culture, and then have authoritative and active policies in place to carry them out. Another internal control focuses on the corporate board of directors. There's now a growing emphasis to get corporate boards more actively involved in ensuring an organization's ethical standing. This means going beyond the traditional laws affecting board members, including the duties of care, good faith, and loyalty. Ethics here goes beyond the law because the law fails to cover the questions of who does the board represent and who are the primary stakeholders. There are also conflicts of interest extending outside the boardroom and that reach out into the entire financial arena. So it's more important than ever that auditors, accountants, lawyers, and analysts avoid conflicts of interest in order to guard their integrity and trustworthiness. After all, it's what they sell of themselves. Another growing ethical area of concern is the rate of executive pay. Is it fair or right that chief executive officers are paid massive sums of money, often hundreds of times greater than what the average company employee receives? As recently as 2005, the rate was 411 times as high and was once as high as 525. Do greed and avarice crop up in your thinking here? Especially when you think of the salaries of professions such as teachers, police, or firefighters, or comparing that to the billions of impoverished people around the world. Then again, in a free market system, doesn't a corporation have a right to set its own CEO compensation rate, especially when the decisions and actions by the CEO greatly add to the company's bottom line? If you're a CEO who makes decisions that bring in an extra $100 million a year, for instance, are you worth a multi-million-dollar a year salary? Is it ethical to impose limits on what a CEO may be worth? But then what if your decisions lead to losing hundreds of millions of dollars, and you're still paid the multi-million? Is that ethical? Another area of concern is insider trading. This is where shareholders make trades and purchases or sales based on private information that only a few could know, and not the general public. Remember, this was the big issue in the original movie Wall Street. Such moves can alter the entire value of the stock within the market. Insider trading also includes tips and private information not released to the public. The information becomes material when it could have an impact on a company's performance in the market, or if it would be important to a prudent investor. The adverse reaction of insider trading is that some get an unfair advantage over others, which can then project itself out into a loss of competition and faith in the entire market. On the other hand, while it may be hard to argue in favor of insider trading, what about the case of a person who has actually worked hard for a firm for many years? Isn't that employee entitled to reap at least some benefit from his or her service? Well, I guess this shows we can argue just about anything, especially on matters of conscience. External and internal controls, conflicts of interest, fiduciary duties, executive pay, insider trading, and the long-range ramifications of Sarbanes-Oxley. Don't think that this course in business ethics is ending. As you enter the workaday world, for you, it's just beginning.